Welcome to this video solution for the MJ Corp question. This deals with a Section 85 rollover. On the next slide is the question. If you have not yet read the question, pause the video here to read through the question. Then moving on to the next slide is the requirements. If you have not yet worked through the requirements, pause the video here, work through the requirements before you move on to the solution. So let's move on to the next slide and start looking at the solution. In this first question, we're asked to determine the floor, the ceiling, and the elected value by Lucy. Now, remember, Lucy is the transferor. She is taking an asset from her sole proprietorship business and going to transfer it to this corporation, MJ Corp, of which she will be the shareholder. And so the elected value is important because Lucy's going to use that as her proceeds of disposition, and MJ Corp will use that as the adjusted cost base of the asset that they're acquiring. Now, the elected value must be between the floor and the ceiling. And so let's first look at what is the ceiling. The ceiling is the upper limit, and that is always going to be the fair market value of the asset being transferred. And in this example, it's $700,000. When it comes to the floor, we have to determine, first of all, whether this is a depreciable or non-depreciable asset. Now, in this example, this is a depreciable asset. So when we look at the floor, this is the requirements that we have to look at. For a depreciable asset, the floor is going to be the greater of two amounts. The first amount is the boot, which is the note, the non-share consideration, and that has a value of $300,000. Now the second component of the floor is the lesser of three amounts, and we have here the fair market value, the cost, and the UCC. And so we look at the floor as being the greater of the boot, $300,000, or the second part, which is the lesser of those three amounts, which is going to be the UCC of $380,000. So we can see here on the slide that the range that Lucy has to elect from is from a lower limit of $380,000 to an upper limit of $700,000. Now, in the question we're asked, or we're told, that Lucy wants to create a capital gain of $90,000 to use up the capital loss. And so in this example then, she wants to have an elected value equal to $590,000. That's going to be her deemed proceeds of disposition, and that's going to create the capital gain of $90,000 that she wants to trigger. So let's move on to the next slide and look at the implications. Capital gain, proceeds of $590,000, that's the elected value, minus her cost of $500,000, that's going to create a capital gain of $90,000. Now remember, the taxable amount is going to be $45,000, and that's going to be offset by the allowable capital loss of $45,000. Remember, terminology is important. Capital gain, capital loss, those are the 100% amounts. Taxable capital gain and allowable capital loss, those are the 50% amounts. So by choosing an elected value of $590,000, that's going to create this taxable capital gain of $45,000, which she will have to report, but it's going to be offset by an allowable capital loss of $45,000, and so that's going to bring the amount that's going to be taxed to zero. Now, let's actually stop here for a second. Remember, the fair market value of the asset that's being transferred is $700,000. Her cost was $500,000, so there's actually an accrued gain of $200,000 on this asset. Now, she's only going to recognize $90,000, and so therefore $110,000 of this gain is going to be deferred until a later point in time. And once again, that's the point of a Section 85 rollover, is the ability to transfer an asset, in this example, from her proprietorship to a corporation, without having to recognize the entire amount of the gain. Now, there's also going to be recapture, so let's look at the CCA class. In the question, the undepreciated capital cost of the asset is $380,000. Whenever there's a disposition of a depreciable asset, what we have to do in the CCA class is to deduct the lesser of two amounts. The first amount being the capital cost, in this example $500,000, or the proceeds of disposition. In this example, that's the elected value of 590. The lesser of the two is 500,000, and so that's going to create a negative balance of 120,000. And we learned that when we're dealing with CCA classes, whenever there's a negative amount and it remains negative, that amount has to be brought back into income. That essentially means we took too much CCA, and so we have what's called recapture. And so Lucy's going to have to bring in 120,000 into her income for the year. So the taxable capital gain of 45,000 will be reported, but that's going to be offset by the allowable capital loss, so that would be entirely eliminated. In addition to that, she's going to have to report recapture, basically business income of 120,000. So that's going to be the income amounts that Lucy has to report. Now let's move on to the next slide and let's look at the next part of the question. We're then asked to determine what is the adjusted cost base of the consideration that Lucy received. Now we're told that with a Section 85 rollover, the first amount has to be allocated to boot. So we're going to take the elected value, allocate that to the boot, which is the non-share consideration. The remaining amount will be next allocated to the preferred shares, if there are any. And then finally the residual will be allocated to the common shares. So let's actually go through this calculation for Lucy. The total elected value, so she has to allocate the 590,000 first to the boot, which is the note, which has a value of 300,000. The residual amount, 290, will be allocated next to the preferred shares, and the fair market value of the preferred shares was 150. And so that's going to leave a residual amount of 140 for the common shares. Now let's look at the preferred shares and the common shares. The total adjusted cost base of both the preferred shares and the common shares will be 290,000. But what was the fair market value again? The fair market value of the shares was a total of 400,000. There's that gain of 110,000 that we said was deferred. Remember, we said the asset value, fair market value, was 700,000. Lucy elects to dispose of it at 590,000. Sorry, 590,000. Therefore recognizing a 90,000 capital gain and therefore deferring 110,000 of that gain. And so that deferred gain now is sort of built into the shares. If Lucy was to sell the shares on the very next day, she would then have to recognize the gain of 110,000. So let's then move on to the next slide and let's look at the PUC. Now the PUC of the shares is different from the ACB. The PUC of the shares is equal to the fair market value of the consideration given for the shares. So in this example, the PUC before any reduction is going to equal 400,000. The fair market value of the preferred shares was 150. The fair market value of the common shares was 250. But we're also told that whenever there's a Section 85 rollover, there could be a PUC reduction. And that's where we come to this equation here, A minus B. That's going to be the total reduction to the overall PUC times the fraction of C over A, and that's going to give us how much the reduction will be for the preferred shares and how much for the common shares. A is the increase in legal stated capital of all the shares. That's the 400,000. B is going to be the elected amount minus the boot. The elected amount again was 590,000. The boot, the note, was 300,000. So the B component is going to be 290,000. And then the C amount is the fair market value of the particular class of shares, whether that be the preferred or the common shares. Let's actually first look at the A minus B. The A minus B is going to be 400,000 minus 290,000. That's going to indicate that the total reduction to PUC is going to be 110,000. But then we have to allocate that 110,000 to the preferred shares and the common shares using the C over A ratio. So let's move on to the next slide and let's look at this calculation a bit further. Again, the total PUC reduction across all shares is 110,000. Let's use the C over A to determine how much of that will be allocated as a reduction to the preferred shares and then the common shares. So let's do the preferred shares first. once again, the puck of the preferred shares is 150 minus the reduction. The reduction is going to be the 110,000 times the C over A. The C is the value of the preferred shares, 150, divided by the total puck, which is 400. And if you work through that calculation, after the reduction, the puck of the preferred shares will be 108,750. Let's do the same for the common shares. Again, working through the calculation, the puck of the common shares will now be 181,250. Now let's look at the total puck. The total puck is going to be 290,000. And so once again, remember we said the total puck before the reduction was 400,000 minus the reduction of 110. So the total puck combined for both the preferred and common shares will equal 290. Now this happens to also equal the adjusted cost base. Now remember we learned that the adjusted cost base is used if the shares are sold to, let's say, an external party. The puck is used if, let's say, for example, the company decides to redeem the shares from Lucy. Now once again, puck is the amount that can be returned tax-free to the shareholder. Now this actually makes sense because remember we said there was that accrued gain of 110,000 that was built into the shares. Now because of the puck reduction, if for example MJ Corp decides to redeem all of the preferred shares and all the common shares from Lucy at their current fair market value of 400,000, then the 290 represents the amount that can be returned tax-free. The remaining 110,000 will be taxed to Lucy. So that's the calculation of the puck. Let's move on to the next slide and look at the next requirement. The next requirement was to look at what are the tax value of the depreciable property held by MJ Corp. MJ Corp will now own the depreciable property. Now because this is a depreciable asset, there's going to be a different value for CCA purposes versus for capital gains purposes. So let's do the capital cost value for CCA purposes first. In order to do this calculation, we start off with the capital cost to the transfer or Lucy. Lucy's cost was 500,000. Then we make an adjustment based on the proceeds of disposition to Lucy minus the cost, and that's where we get that capital gain of 90,000 again. Now because Lucy was only taxed on 50% of that capital gain, MJ Corp can only add the taxable capital gain amount to the cost of the asset for CCA purposes. And so the capital cost to MJ Corp for CCA purposes is only going to be 545,000, not the full 590,000. However, the amount that MJ Corp will use as the adjusted cost base for capital gains purposes will be the full 590,000. So that brings us to the end of this video solution for MJ Corporation. We'll see you in the next video. Good luck with your studies.